Hello and welcome to the Money Show. I'm Kavita Thapliyal and it's your favorite segment, Meet Your Fund Manager. And today I have with me the very interesting Harsha Upadhyaya, CIO, Equity, Kotak AMC. Harsha, welcome to the Money Show. And today we are going to talk about Kotak Nasdaq 100 Fund of Fund. But before I get into the nitty-gritties of this fund, I really want to understand how are you looking at the market, because that is one question that everyone has on their mind, specifically after the IMD predictions on monsoon and the kind of good data that we saw coming. We've started September series on a very good note. So there are mixed vibes as far as the coming quarters are concerned. But your understanding and your view is very important. Your view for maybe next 2 quarters. What are you seeing unfolding very different in the Indian market right now?
Kavita, as far as Indian markets are concerned, they have remained quite resilient over the past several quarters. We have seen Indian markets behaving quite differently than global markets in terms of the strength, I mean, and that continues. We have also seen significant inflows into our equities, both from domestic investors as well as from foreign investors. That's also playing its part in terms of keeping the markets on a strong foothold. As far as earnings are concerned, the last couple of earnings seasons have gone well. There may not have been a very strong upgrade cycle yet, but clearly overall earnings have been better than expectations. So we continue to believe that earnings season going forward as well will remain quite healthy. So given the fact that there are no big macro challenges and also the fact that earnings are moving reasonably well, we should expect markets to remain fairly healthy. Having said that, the two red flags in our view at this point of time, one is obviously the valuation risk that everybody is concerned about in pockets of our market, not everywhere, but definitely in the broader end of our market where money has also chased this momentum. One needs to remain cautious about the valuation risk. The second is the inflation risk. While it had moderated quite a bit, I think given the fact that monsoon has not gone well in the month of August and also on a cumulative basis. And also we have seen crude oil moving up from nearly $70 to a barrel to almost $90 to a barrel. We need to keep an eye on how inflation moves in the next few months. So these are some of the red flags, but otherwise our markets remain quite healthy at this point.
Mm-hmm. Any concern from the US market that you might see trickling on ours as well?
See, clearly we are in a connected world. So to that extent, any growth concerns in US or any concerns on the interest rate cycle there could have an impact every now and then. But clearly Indian growth rates have been quite resilient. We have performed much better than many other economies, including US economy. And also our monetary policies were not same as US or some of the other developed nations followed, because of which they seem to be in a bigger trouble in terms of containing inflation at this point of time. So I would say yes, from time to time you could have some impact from other markets, but clearly as long as our growth rates are fine, I think once the dust settles, our market should behave better.
Right, right. Harsha, talking about two very important events. Now, first the festive season and also the state elections coming up. Now, looking at the quarter results that were released, going ahead and the way monsoon is also unfolding, do you think consumption and sectors related to this entire period would have major concerns? How are you looking at these two events and the market's impact?
See, clearly, if you look at our portfolios today, we were not so overweight on the consumption basket because of two reasons. One, because of the valuation risk in the sector, and second, because of the concerns on the rural economy, which had not kind of normalized post-COVID, and it was taking more time compared to urban consumption trends. So to that extent, those risks are still there in the market, and especially, as you rightly said, since the month of August, we have not seen great rainfall across the country. We could see further impact on the rural consumption trends even going forward. So one needs to watch that out. Usually, the last 4 or 5 weeks of the monsoon are also very crucial. I think we are in that critical juncture at this point of time. And generally, whenever monsoon is deficient by more than 6% compared to the normal, then you have impact on inflation to some extent, and also some impact on the rural consumption trends. We are currently running at about 10 to 11% deficient. So we need to see whether next 4-5 weeks the rainy season will pick up and whether the deficiency will reduce or not. I think that will be very crucial for the consumption trends. So to that extent, I think consumption stocks are not an outright buy at this point of time. One needs to see what happens on the rainy season.
Mid cap and small cap, do you think the run-up is now overvalued, and also the change in strategy for large caps now?
Clearly, large cap valuations are still more comfortable as compared to small caps in our view. Almost all of the segments are showing valuation trends which are slightly higher than comfort levels, and more so in mid and small caps. And also in case of worries on the inflation or on the interest rate trajectory, could impact mid and small caps more from an earnings perspective. So to that extent, I think we need to be a little more careful in that basket as compared to large caps.
The kind of sectors that you think the valuations are decent, and we might see the exposure going up in your portfolio across funds?
Kavita, clearly there are no pockets of undervaluation in the market at this point of time, at least to our mind. So to that extent, it will be more of bottom-up stock picking. There are no sectors which are uniformly undervalued or fairly valued in our opinion. So we will have to keep looking for downside volatility for whatever reasons that comes in the markets. And if we are not caught up by the fundamentals of those particular businesses, then those will be good times to accumulate. But otherwise, I think almost all sectors are either fairly valued or richly valued at this point of time.
All right, let's shift our focus to a specific fund that we are talking about, and let's talk about the US market in depth, because Kotak Nasdaq 100 Fund of Fund is the fund that we are going to cover now with you. So what's the status right now? Can people invest money via this fund? Because I believe there has been, the restrictions are still on, but what about the limits?
Currently, limit is open to a small extent. So there is a limit of $300 million that we can take in this particular route. And whenever we hit that limit, and if there are no further limits available, then we'll have to close the fund for subscription. But currently, since we have seen some redemptions in the recent times, there is a bit of a window that is available for new investors if they are keen to take Nasdaq exposure at this point.
All right. Let's talk about the specific that an investor needs to know, because this kind of a fund in your portfolio should be placed only when you are looking at a diversification in a particular sector, in a particular geography, right, Harsha? So what are the things an investor needs to know before you diversify your portfolio for this?
Absolutely, Kavita. Whatever you said is 100% correct. This should be looked at only from a view of diversification. And as it's a thematic product, the proportion should also be much lower compared to your overall investments. And the reason to look at this is some of these companies which are part of Nasdaq index, for example, are not available for investments in any other format in India. For example, there are no proxy ways of investing into some of these companies. These are all very high technology, innovative companies. And over the cycles, we have seen that these companies have really grown, and they just don't operate in US, for example. They operate mostly across the globe and have very significant business runway for growth. So to that extent, if anybody is looking to invest in any of these stocks, this is the simplest way to take that exposure, because you will be taking a passive exposure to Nasdaq. And also, you need not worry about foreign currency exchanges, etc. You can invest in rupee account. It's a rupee fund, and the money gets converted into dollar and gets invested into the entire basket of Nasdaq stocks. And whenever you redeem, depending on whatever is the foreign currency exchange rate, you will get the money back in again rupee. So to that extent, not only this gives you exposure to US markets through Nasdaq, but also gives you a hedge against rupee depreciation against US dollars. So that's another additional point that is significant from an investor perspective.
Could you give us the index breakdown right now that Nasdaq 100 has?
Again, most of these stocks have significant operations, not just in US, but across the globe. So I would say generally these are high technology companies, innovative companies, which have been operating in US as well as outside US. And the index composition also keeps changing based on the market movements of all these stocks on a relative basis as well. But for an investor, retail investor, it's better to look at Nasdaq and see where the Nasdaq is moving. Since it's a passive fund, that gives a close understanding in terms of how the fund is likely to behave.
So Harsha, what's the difference between having good amount of exposure in tech in the Indian market and having a good amount of high performance tech companies in Nasdaq 100? What's the difference? What are the sector exposure risk which might get involved?
See, clearly, when you look at Indian IT services sector, it's as the name suggests, it's IT services rather than IT products or high technology innovation-led companies. As far as Nasdaq is concerned, it has companies across the spectrum of technology, and also not only just operating in US or one or two markets, but across the globe. So that's the significant difference between your IT exposure in the domestic market vis-a-vis the Nasdaq exposure. That's point number one. Second is because these segments are looking at higher growth than IT services, and also there is a scarcity premium. Some of these stocks may be quoting at a valuation which are much higher than IT services. So both growth rates as well as valuations could be very different than what you see in the Indian market. And one should not take Indian IT sector as a benchmark or think that a proxy for Indian IT sector. It's completely a different exposure. It also is in a different currency in that sense. So it's going to behave very differently than our IT sector at many points of time. For example, last 1 year, while our IT sector has not done that well, the Nasdaq per se has done quite well, and it's done much better than overall Indian market as well. So there will be periods of outperformance, underperformance compared to Indian markets or Indian IT sector. And that's the reason for diversification rather than just looking at point to point.
So exactly. So the question over here is, what is the reason behind Nasdaq performing so well despite their own economic concerns in the US? What's the reason and the road ahead that you see for the US economy and the impact on Nasdaq?
See, usage of technology or embracing technology is not going to stop because there is a down cycle in the economy. And especially these are the companies where they are also into some of the areas which cannot be kind of shut down because your profitability is lower or your outlook is not so great on the economy. Unless you are investing in just a pocket of, let's say, IT services, where the business is derived from companies making investments into IT services, which could also see ups and downs depending on the outlook for the economy. The Nasdaq companies are so different. There could be continuous opportunities for them to grow. And secondly, they are not just wedded to one particular market or one geography. They have operations across the globe in many cases and have significant market shares in countries or economies other than just the US. So these are some of the reasons for it to behave differently. And also the starting point also makes a difference, right? There was a point of time after 2021 where Nasdaq had fallen more than Indian IT sector, for example. So from that perspective also, the valuations had corrected to more meaningful, had seen meaningful correction. So from there on, we have seen a stronger pullback in those names as compared to Indian IT sector.
Harsha, one very basic and a very important question. Now, when an investor wants to have a sector exposure like this, it's very important for them to play it very smart. Okay, having exposure in Nasdaq 100 fund and also having the similar exposure in Indian companies via a flexi cap, multi cap, and a large cap. How do you avoid the case of over diversification?
See, only very few flexi-cap funds would have exposure to international stocks, and not all of them would have taken exposure to the Nasdaq heavyweights or all of the Nasdaq stocks.
Indian exposure in IT companies, not necessarily the international exposure, the Indian exposure in IT.
Yeah, Kavita, as I mentioned earlier, yeah. Indian IT sector, the growth rates, the valuations, the outlook, everything is very different as compared to Nasdaq basket. So to that extent, one need not worry about having both of them in the portfolio.
Okay. So there can't be any case of over diversification. I mean, you just need to restrict your exposure maybe to an international market. That is something that needs to be taken care of.
That's all. That's all.
Okay. So on a guideline basis, what should be your international market exposure in a portfolio? A lot depends on your financial goals and your risk appetite and how much place do you have in your portfolio. But as a thumb rule, what's recommended?
Kavita, as you rightly said, there is no one size that fits all. However, we do say that the thematic exposure, whether it is international or domestic, individual sectors or multi-sector funds, it should not be more than, say, 10% of one's overall portfolio. So I think that thumb rule should work for most investors, but obviously it will be better for each investor to find what is appropriate by having a discussion with a financial expert.
Right. One last question. So in this fund, one can invest via SIP or lump sum. Both way of investments are allowed and open right now?
Yes, currently both routes are available and one can look at investment.
All right, that will be all. Thank you so much, Harsha, for being on the show and helping our viewers with not only diversifying their portfolio to international market, but also about Kotak Nasdaq 100 Fund of Fund. Thank you so much.
Thank you.
Welcome back. You're watching The Money Show with me, Kavita Thapliyal. The Securities and Exchange Board of India, SEBI, the market regulator, has released a consultation paper to clamp down on financial influencers or finfluencers. In recent months, finfluencers who use social media platforms like Instagram, Facebook, YouTube, X to offer advice and insights on various financial topics have come under SEBI's scrutiny for wielding enormous clout among their followers and the potential consequences of misleading them. India's influencer market is estimated at $75 to $150 million a year as compared to the global market of almost $1.75 billion. Now, this is an industry that has become mainstream within the advertising space and is only expected to grow as more Indians go online. So, in the wake of this, the Advertising Standard Council of India has also come up with their own guidelines and have taken steps ahead against a few influencers. So let's deep dive in this interaction. I have with me Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth Management, Manisha Kapoor, CEO and Secretary General, ASCI, and Sandeep Parekh, Managing Partner, FinSec Law Advisors. So, good evening and welcome to the show. Manisha, I'll come to you first because it seems ASCI has really come up with, you've been continuously working on this matter and there have been a fresh set of guidelines that's been released and also tough steps against few influencers. What is the matter so far? What's the status of this entire process which you are doing on board with SEBI?
Thanks, Kavita. So essentially, we've been working in the area of influencers now for more than 2 years. We first brought out our influencer guidelines after a lot of consultative work in May 2021. We've been, of course, following this sector because it's a really, it's a new format of advertising. It's constantly morphing and evolving. And I think besides the general guidelines, we saw over the last couple of years, I think the number of influencers talking about products and services related to health and finance in very, very strong ways. And one doesn't know the antecedents of some of these influencers, whether indeed they are financial experts or not. And a lot of people, while, they may talk from their own experience, we all know that one person's experience may not be genuine or general advice that can be given to everyone. So, you need training, you need a certain orientation in order to be able to give out advice to other people who may have very different investment goals or risk appetites as compared to what you may have and what you've kind of learned over your experience. And that's why we felt that both in health and finance, the risk to consumers was quite high, given that, they may be following people who they don't know if they're experts or not. And of course, in parallel, we know that SEBI has also been, having this view that it's only registered, entities that are in a sense the recognized experts to give out this advice. And I think it's both these issues that made us eventually come up with the guideline, particularly for financial influencers, to make sure that that they have the experience and the expertise that one would consider them to be an expert when they give out advice to other people.
All right. Feroze, moving forward, I would like you to explain us a consultation paper that's been drafted and floated by SEBI as to what kind of concerns and what kind of questions and steps are proposed by SEBI in the consultation paper.
Yes, Kavita, good evening. So if you look at the consultation paper, SEBI has brought up some issues which are very, very valid and contemporary given how the social media has progressed, especially post the COVID lockdowns and stuff where financial advice became very freely available on the social media. The one problem which they have is that there's no regulation to finfluencers currently, right? If you look at it and make a comparison with an RIA, registered investment advisor, which is with SEBI, there are several conditions for you to actually be a registered investment advisor. And the advisor also is just giving advice and earning out of it. Here you have a finfluencer using a digital medium to give advice and earning they're using different business models to earn and is not regulated. So the first problem being highlighted is how can there be such a dichotomy depending on the stream or the method of delivering the advice. One is digital, one could be phygital, like a human being, but one can't be completely regulated, the other cannot not be regulated. So that's the first problem. The second is how payments are being made from 10,000 rupee kind of a fee to 7.5 lakh kind of a fee range has been seen, which is the second problem which SEBI is highlighting. The third is that there are tie-ups which are being made with registered investment advisors or distributors to promote their products, and referral fees are being passed on without any caps and regulations to that. So these are the few problems which SEBI is wanting to plug in with this consultation paper, whatever final form and shape it takes. That's point one. What is it proposing? That's the second part. It is proposing a complete ban on any financial dealing between a SEBI registered entity and the finfluencer, so that there is no bias. Second, I think they're largely wanting to make sure that when it comes to stock recommendations, there is no front running, which is quite possible. And I will not say prevalent because that will be making an exception a general rule, but it's very much possible. See, in a mutual fund, if a influencer is giving advice, there's no price movement because of one person's advice. But if a influencer with 1 million followers is recommending a stock and pre-owns that stock, that's practically front running. So the second thing which they want to plug out is any possibility of front running. I'm sure they might have found some stray instances of that happening. So this is the basic first reaction of the consultation paper. But I'm glad that the ball is set rolling and it will take shape in a more logical fashion after having consulted several stakeholders.
Exactly, but still a question remains on the infra as to how will all this happen. Sandeep, so really appreciated SEBI has taken the initial step towards bringing transparency and accountability on this, fast growing field of financial influencers. But then having said that, Sandeep, do you think it's enough? How will you regulate them? Because I think that's even... Obviously, getting registered is one of the crucial steps, but then regulating the registered ones and seeing to it that, you curb out the unregulated ones, this is going to be a tough task for SEBI. How is all this going to be planned? And what about the infra to implement all of this? Sandeep?
Hi. So I think the key thing is I don't think SEBI has bandwidth to regulate all influencers really, and which is why if you see the paper, it's taken a very graded approach, which is it's saying that if you're really working with a registered entity, only then the influencer will need to register with SEBI. And that essentially means that probably 0.01% of all influencers will be required to register. So unless you're kind of working with a registered intermediary, you're really exempt from SEBI. Unless, of course, you're providing investment advice, in which case, of course, you would need to be registered in any case. So I think it's kind of somewhat of a limited scope which SEBI is trying to kind of attract by limiting its own house.
Sandeep, what is the way ahead now in terms of, do you think the consultation paper would be enough?
No, I don't think it's enough. I think a large part of the solution has to come from the investor end. Ultimately, if investors believe there's somebody giving them advice which is going to double their money in 2 days or 5 days, this is almost like knowingly putting your money into the ocean. And at at some point, investors also have to realize that there is no free money in the world. There is something known as investing. It is long term. It is based on diversification, and all the kind of snake oil those people are selling them, it really doesn't work. I think a lot has to come from the investor side by they're recognizing that free money doesn't really exist.
Feroze, do you agree with Sandeep's points that he's highlighted that definitely SEBI doesn't have the bandwidth so far, and also a lot of onus is actually on investors to make the right decision as far as their hard-earned money is concerned?
Yes, Kavita, I completely concur with Sandeep Bhai on the basis that, protection of an investor cannot happen without educating the investor. So if an investor is educated, then he automatically is protected. Now, if you look at several frauds which have been unearthed over the last couple of decades by SEBI, largely the people who have got stuck in those frauds, a reasonable portion of that are uneducated investors who have not been educated very well. Be it small chit funds or even the biggest scams, I don't want to name them. You see that Metro City seasoned investors have been able to exempt themselves and avoid these bullets which have been shot at them. So point is, if you want to protect an investor, you have to educate them. There's no way to handhold them through a daily activity to prevent them from something which is invoking greed in them. So free money, like Sandeep said, doesn't exist. So you will have to believe that some things which are not too good to be true may not be true in the first place. So protection can only be the outcome of education. And I think investors beware is something which we have to take more seriously as each constituent from an investor standpoint also.
Manisha, on your end, what kind of influencers are on your radar, and so far, what all inquiries have been done?
So since we launched our guidelines 2 years back, actually influencer complaints and even our suo moto work that we do in the area of influencers is now close to 25% of the work that we are doing and the kind of cases we take up. So we certainly have a fairly good insight into how influencers are working and what kind of promises they're making, and this is of course across different categories. But as I said, given the harm that both health and financial influencers are capable of causing the audience, I think this is going forward going to be a specific area of focus for us. We have some AI-based softwares that allow us to shortlist influencers. But I think I agree with, the other panelists that this is only one end of the story. I think, it has to be complemented through education programs. Both regulation and education have to go hand in hand to offer the greatest protection that you can for consumers. So while we do have some technology and we do have, the ability to map some of these influencers, the fact is that, they are out there in the millions. So we will catch a few, but a lot of them may not be kind of, brought under the regulatory scrutiny. So the investor education is something which has to go hand in hand, and a lot of efforts need to be put in by the correct experts and by the industry in making sure that financial influencers don't undo all the good work of education that some of these companies have been doing for so many years.
We'll have to wrap up this discussion, but then one last question to you. Talking about investor education, yes, it's not that investors are unaware about the fact that how their money is drooping, and these finfluencers or the fake finfluencers have been taking, giving them wrong sort of advices. A word of caution from your end, and also how important it is to understand the kind of advice they are taking. Okay, first of all, there are no free lunches. You've got to really bother about your hard-earned money that you're putting into, and before that, just do a little bit of homework. Understand the kind of investment instrument you want to put your money in. Social media, yes, it's free advice, yes, it's quick money, everything is okay, but then there is a process to it, and there is a procedure to it that you should be following. Feroze.
Yes, Kavita, like you said, it is free money, but largely to the finfluencer. It's not been free. It's free money donation from a lot of recipients of the advice. In several cases I've seen. Point one. Point two, I think you're also speaking about infrastructure. I think SEBI's presence in several of these social media platforms has been abysmal. I'm sure they must be thinking of trying to create a reasonable presence in all the 3, 4, 5 important social media. Now, if you look at Twitter, Instagram, YouTube, the presence has been very, very low on the regulatory side. And I'm sure they're coming and giving the right information. And if that's more visible, it's a daily reminder saying this is the right information and this is the wrong one. Third, I think what's the need for you to take advice on a day-to-day basis when there are other platforms, like there are very well regulated electronic medium which are available. So you can always take advice by following any of these amazing business channels, including yours, Kavita, rather than going to an individual, because the individual may not have the research capability and will not be able to garner several other experts from different streams of industry to give good advice from an investment standpoint. So why rely when there's already something which is more credible available on the social media if you just follow the right handles?
All right, I think we'll have to really wait for the deadline that's been given for the consultation paper. And once again, after that, I think we guys will join on the panel and discuss more on this. Thank you so much, all three of you, for being on the show and helping our viewers with this today. All right, so time for a quick break on the Money Show, and after that we'll be joined by Anil Rego to answer your portfolio queries. But before that, before I go on a break, I'm going to leave you with our WhatsApp number and email ID, where in case you're watching us live and you want to send us your queries right now, you can do that. Do WhatsApp your questions, and you can also email us your queries on our email ID. All right, welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, there are plethora of funds available in the market, and to invest your hard-earned money in, how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Anil Rego, who will answer all of your queries today on the show. Anil, good evening and welcome to the show. And I have my first viewer online, Dr. Rajkumar. Hello, good evening. Okay, I think we will try to connect with him once again. We had him on the line, just lost him. So, Anil, the funds that he has in his portfolio, okay, he has almost 10 funds. HDFC Midcap Opportunities, Parag Parikh Flexi Cap, Quant Small Cap, Quant Infrastructure Fund, Bandhan Sterling Value Fund, SBI Contra Fund, PGIM Liquid Fund, Motilal Oswal Mid Cap, Tata Digital India Fund, Mirasir, Fang Plus NYC ETF also. I have Dr. Rajkumar online with me. Good evening, Mr. Rajkumar. Thank you so much for sending us your question. I was just reading out the name of your funds, and it looks like you have 10 funds in your portfolio. You've been taking care of your portfolio on your own, or this is just...
I do it on my own, madam.
Okay.
I do it on my own, yeah. So, I don't know, I was just actually wondering, should I alter my funds or, just stay invested? One of the funds I had problem is in the digital fund, because the digital space assets has not been doing very well since last year or two. So, that's something I've still been holding. And I just want to know what should I do with the rest of the funds.
You've been consulting a professional to make this portfolio, or you've been doing it on your own?
No, I do it myself. I just read myself and just do it on myself. My own.
Okay. Okay. So far your investment value is 60 lakhs.
Investment value is 60 lakhs and given around 22% return last 2-3 years. 22%
Sure.
CAGR.
And, okay. 1 lakh investment every month, and you want to reach to almost 1.5 crores in next 2 years' time. Is that the goal?
Not 2 years, maybe next 4 to 5 years. So that's what I don't know.
Next 4 to 5 years. Okay.
Yeah.
Sure. Okay. Also, one more thing. So you've been investing since how long? I'm sorry, I missed that.
Not very long, actually. I started doing mutual funds only a few years back, probably 4 or 5 years back, probably. I'm not an active investor. So last, I think, COVID time we started. We had nothing much to do during COVID, so we started investing in reading about it and investing in during that time. So
Got it. Got it. Got it.
Yeah.
Any specific goal tied up with this portfolio, or it's just wealth creation that you're looking for?
no, it's basically wealth creation, and I'm also like 45 now, so probably I work in the Air Force, so I have another 13, 14 years of service left.
Service left.
And probably
Okay.
and need some good lump sum before I leave. So that's what I'm looking at.
All right. Thank you so much for sending us your question and giving us an opportunity to serve you by helping you out with your financial portfolio. So with me is founder CEO of Right Horizons, Anil Rego. Anil, so we've taken this question, and 10 funds in the portfolio that Dr. Rajkumar has, and in 4 to 5 years, you want to achieve a corpus of 1.5 crores with 1 lakh investment every month. So far, the investment amount of his portfolio is around 60 lakhs.
Sure. So I think first of all, congratulations and building up your wealth, getting it to about 60 lakhs right now, and also wanting to grow it. I think from the numbers that you said, it looks reasonably comfortable that 60 lakhs along with a 1.5 lakh a month, type of SIP will take you to your, goal that you wanted. Yeah, so one or two things observations that I had, while you sort of continue on this journey. The first thing is, I think, you have too many funds. Okay. So you need to go back and see, 10 funds is difficult to manage and stuff. So it'll ideal be to come back and see how you can bring it down by a couple of funds at least. Yes, I saw that you have maintained some sort of allocation by keeping some in liquid funds. You also have, a number of funds out there. So the second point is, I'm not sure of your risk profile. So the amount of debt and equity, that you have, I think should be in line with your risk profile. Maybe one or two of the funds that I could think that, you can consider right now, keeping in mind current market conditions is possibly look at a multi-cap type of fund, and, something like an ICICI Pro multi-cap may be sort of one of them. The second is, for a part of it also, you can end up taking a higher level of risk. So you can do maybe a small cap fund. Okay. And in terms of small cap fund, you can either look at, something like a Nippon India. You can also look at an SBI, one of these small cap funds to add to your overall. What may be important is for you to continue to, review your funds now that the asset size has, grown up and will continue to grow up. I think do a periodic review of it, maybe at least once a year, and, work towards your goal. All the best to, achieving that 1.5 crores that you want to achieve.
All right. Do I have Dr. Rajkumar with me online?
Yeah. My primary investment is in Parak, flexi cap fund. So that's why I put the maximum amount of money. The rest of it, I don't take too much of risk putting in small caps and other kinds of funds which are little risky. So I invest a very little amount of that, and probably 5,000 or 10,000. I'm like, when I invest 1 lakh, I put around 70 to 80,000 in Parak, your flexi cap fund. So that's where the maximum investment is. And rest of the fund, then I equally distribute like SBI contra fund or SDFC mid cap opportunities. That's how I work. Yeah. So just want to know, probably after 2 years or 5 years, what would be the lump sum I'll be able to sort of carry home, once I go at this
Approximate
stage.
corpus, Anil, we really have to move on to the other viewer also who's on the phone line. Anil, quickly, what do you think the approximate corpus amount could be?
So I think he could also touch 2 crores. Of course, I didn't get the query early, so one is not able to do a precise computation. But I would think that, he should be able to hit in his 5 years, he should be able to hit about 2 crores type of corpus out there.
Let's move on. I have Antariksha Mathur with me on the phone line. Hi, good evening. Thank you so much for sending us your query. And I believe you have done your investments in a couple of funds that I can read. 5 crores in 20 years. And I think I have all the details of your portfolio. Is there anything else that you want to add?
Hi, Kavita. This is Antrix. So, yes, you already have the details. I just wanted to add one more question. I have some small amount to invest in as a lump sum. So, which mutual fund should I go with, or shall I, shall I churn it? Shall I turn it into, small SIPs of some wholesome amount? So
Got
that's
it.
one thing. And do I need to relocate the funds, or should I stay invested in the same?
Sure. All right. Anil, you have the question on you?
I don't think so.
Anil?
Can you? Yeah.
Oh. You want me to read out the details?
Yes, please.
Okay. So, the current SIP and lump sum investments are into Axis Long-Term Equity, DSP Tax Savers, Tata India Tax Saving Fund, Invesco India Tax Saving Funds, Nippon India Small Cap, SBI Small Cap, Mirasit Emerging Blue Chip, Quant Mid Cap, Parag Parikh Flexi Cap, total corpus 5 crores in 20 years is what he wants to achieve. He can add 10 to 15,000 more via SIP and lump sum 50,000 in small chunks. That is what he says. The name of the funds also flashing on the screen. Maybe if you want me to repeat again, I can do that.
No, that's fine. So actually, I didn't have the name when the query came to me, but yes, I had the details. So currently, I guess his SIP is about 13,500, and with the additional 15,000, so that can also grow well. Okay, so I would suggest something like add up to some of the existing funds as far as possible. A significant part of what he has is all mid cap and small cap, mainly small cap actually. Yes, he also has started a Parag Parikh fund out there. So what I would think is for his 15,000 additional that he wants to look at, he can look at a Nippon India small cap fund and a quant mid cap. He can top up, say maybe 4,000 each. The Parag Parikh fund, he has done a lump sum, so he can also start a systematic investment of say about 7,000 rupees in that 7,000 per month. And you can also consider, a fund like ICICI Prudential Multi-Cap, just to diversify a little bit, from the small cap side. Yes, at the current stage, we believe small cap funds will do well, but, it's not a good idea to, over exceed on any one sort of category, because, if you don't get the turning right, then, you will be impacted there. Again, an observation that, from all his tax saving funds, I think 4 of them, he can sort of bring it down to 2 funds and maybe start SIPs only in the better performing 2 funds and then, continue to do out there. He also, I think, was looking to do a lump sum of 50,000. And I would suggest at a point like this, market has also moved up. You can do a systematic transfer and maybe put into a liquid fund of SBI and then do a systematic transfer into, say, a large and mid-cap type of fund. So what one is trying to achieve through this is that you have, a distribution across multiple market caps for you. So, large cap, I've left it out, keeping in mind it looks like you have a higher risk appetite, but starting off with the large and mid-cap, multi-cap, and then mid-cap and small-cap funds, right? So I think that is something that is good. So in terms of what he's invested already, you would have almost like 41 lakhs in lump sum. Okay, so to achieve 5 crore, you would need almost like 31,000 rupees a month. Okay, so you would need to step up your investments a little bit, but it's not a problem if you're not able to do that now. I think over the years, you can sort of keep increasing it, and step it up, like this is step up SIP. And as your income sort of increases, you can do that. And I'm sure you'll be able to achieve your target of 5 crores in 20 years.
Antariksh, all the best for your investment portfolio. I have Anurag's question with me, and Anil, you might want to check if you have this query on you or not. He is 23 years old and he started his investments in mutual funds after getting his first job. So, Anurag, congratulations over that. He's investing 5,000 from his salary now. He has SBI small cap, he has HDFC mid cap opportunity, HDFC flexi cap. Now he wants to have a corpus of 1 to 5 crores in 10 to 15 years, and he'll also step up his SIP going ahead is what he says. So Anurag, congratulations. Thank you so much for sending us your query, and you know, it's really very encouraging to see that you started off your investment at this age, 5,000 rupees, and you're also willing to step it up. But then I think a reality check when it comes to achieving the corpus, you know, 1 to 5 crores, a lot will go in terms of investment amount, you know, when you have that wider range. Anil will explain you how that amount varies. But so far so good. It's a good first step. What will you say, Anil?
Yeah, what is the tenure that he's looking at?
10 to 15 years, 1 to 5 crores, he says.
Okay, so if it is, yeah, so 15 years, I definitely, I'll just calculating it out here. So if he does say a lakh a month at, you know, something like 12% for 15 years, it'll come to about 5 crores. Okay, so that's
the higher end of the
reality
time
check.
horizon. You've taken the higher end of the corpus
Yes.
amount also. That's that.
Yes.
I mean, he's ready to step up. I hope he's listening, and he might just aim to step it up to that amount that you just mentioned. But yeah, how can he go ahead?
Yeah, so I would think that it's a good idea to do a reality check, okay, and come back and see what are you building it towards, or what is the objective, okay, and maybe one can also simulate it, on a spreadsheet, saying that, okay, what if I keep increasing it by say a 5%, or a 10% per annum stuff? It'll definitely go higher, but I don't think it'll hit that 125 crores. Yes, at an early stage, I think it's great that you're starting early. Okay, maybe you can focus on mid and small caps right now, and that will hopefully give you more than 12%, right? So maybe you can catch up a little bit early. But keep in mind that if you are doing so mid and small caps, and taking that higher level of risk, you should also be okay with the volatility that comes with it. So I would think that this money, then, you should not be touching or needing, in the short term or even medium term, if you are sort of taking this level of risk. But yes, all the best, and I'm sure what is a lakh may end up going to 5 lakhs, and or higher, and I'm sure you'll do well, and possibly get closer to your golden number.
All right, that will be all. All the best, Anurag, for your investment portfolio. And with that, it's a wrap. Thank you so much, Anil, for being on the show and helping our viewers with their financial portfolio queries. All right, so time to sign off, but then I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your questions. So do send us. Also, you can watch our show on YouTube. If in case you want to leave a question there, you can do that in the comment box on our YouTube also. Thank you so much for watching. Goodbye.